Welcome to the NFO review series. It seems to be the season of NFOs, and in this video I'm going to be reviewing the HDFC Dividend Yield Fund. A dividend yield fund invests a minimum of 65% in high dividend yielding stocks and the balance 35% in other stocks. Now, high dividend yield stocks are those companies which have high amount of cash. They're considered more stable and they pay out high amount of dividend. The HDFC Dividend Yield Fund is going to choose companies which basically have a high amount of dividend at the time of investment. The fund is also going to be sector and market cap agnostic, and it's going to be benchmarked against the NIFTY Dividend Opportunities 50 Total Return Index. First off, let's consider the advantages of high dividend yield stocks. Well, since dividends are derived from a company's profits, it's fair to assume that in most cases, good high dividends are a sign of good financial health. And also from an investment strategy perspective, buying companies with an established history of good dividends also adds stability to the portfolio. The advantage of a dividend yield stock is that you're getting stocks which not only give you a good income but probably also have capital appreciation available with them. However, dividends are not guaranteed and they're dependent on various factors like macroeconomic factors as well as company specific performance. Another potential downside of investing in high dividend yielding stocks is that these companies are really not high growth leaders. There are some exceptions, but most high growth companies would prefer to invest back into their businesses, maybe in form of R&D, capital expansion, mergers and acquisitions, and so on and so forth, instead of issuing dividends to the shareholders. Also, there could be cases where the stock prices are declining and hence the dividend yields tend to look better. Of course, you can't go just by the dividend yields alone. The valuation of the stock that you're investing in also makes a big difference to the overall performance of the stock. High dividend yielding stocks bought cheap obviously are expected to do well, but high dividend yielding stocks bought at high valuations may or may not give the desired results. And historically, high dividend yielding stocks have been cheap stocks, but today the high dividend yielding stocks have also become expensive. Investing for most part is long term. And when you're really looking at investing for the long term, you need to be more concerned about investing into companies that have a potential for growth rather than just looking at companies which are high dividend yielding. My take, this is a very concentrated strategy. There are very few dividend yielding funds available in India. The performance is okay. Again, I would say this is more of a tactical allocation. If you believe that markets have peaked and right now it makes sense to look at dividend yield companies for the next couple of years, then yes, you can get into this fund, limit your exposure to up to 5%. But otherwise, I would think that any high dividend yielding stock available at a low valuation would in any case be present in a multi-cap fund. At best, you can take some exposure if you really find this to be a high conviction idea. And remember, it's going to be a tactical allocation. For others, just continue with your core allocations into broader funds like multi-cap funds. Do click on the bell icon to subscribe. I do look forward to your feedback. Till then, bye-bye.